What is up, YouTube? I'm Adam O'Dell, Chief Investment Strategist of moneyandmarkets.com and founder and co-editor of Green Zone Fortunes. I am, again, this week joined by my research analyst, Matt Clark. He was missing us. We were missing him last week. He was on a week-long vacation, which makes me think he's European or something. I can't remember the last time I took a week-long vacation. He was certainly lucky in that regard, but I'll let him, if you'd like to, tell you guys where he was and why.
Yeah, believe me, I'm with you. I don't normally take vacations just because I just can't get in that mindset. And two, this really wasn't a vacation per se, but it was a very welcome visit. Just to kind of keep it brief, but my wife and I are both from Kansas originally, and our oldest son lives in Kansas now with the job that he has, and he and his girlfriend recently gave birth to our first grandchild, baby Gray, and we had the opportunity to go and spend about 7 days visiting our new grandchild last week, and he's adorable, just itty bitty thing, and I am now his best friend because he would only sleep and look at me and not anyone else. So I'm kind of the envy of the rest of the family, and I'm okay with that. But yeah, it was adorable. And I actually shared a picture of myself and baby Gray on our marijuana market update that came out last week. So if you want to check that out, you can. Awesome. But yeah, so it was great. It was, and Adam, you're familiar with having new members of the family, so you can definitely relate. I think, and anyone who has, it's a joy. It's a great experience. Yeah, for sure. Congratulations. And yeah, I definitely know the grandparent excitement. So we have an 8-month-old, our first child. And yeah, I was joking with my wife. I said, our parents are like rarely visited, in the previous 15 years. And now they're like filling up every other month as far as our calendar goes. So my wife is planning quarterly visits to Kansas. So there you go. Yeah. That's exciting for her, I guess. So,
well, again, congratulations.
Thank you. But yeah, let's jump right into it. And, obviously we had a short week. And spending a week on vacation-ish, it gives me a lot of time to kind of think about different things. And I'm always in that mindset. I'm kind of like with Adam and with Charles, always thinking of different things related to the market. It's one of those things where we just don't really escape work ever, much to my wife's chagrin. And I really started thinking about, the performance of stocks in the market and kind of how things are correlated together and how they all kind of piece together. And I worked on this for our weekend podcast, our Bull and Bear podcast, which will come out on Saturday, I believe. So you'll be able to see more of where my thought process was. But over the course of this, I came across some really, really interesting research, and I wanted to bring in Adam because Adam is in terms of the market is about as expert as you can get. I mean, he knows it, and I'm not touting it because he's on the video call. It's because it's legit, and I get very skeptical as a former journalist. I look at things with a very close eye and always assume the worst. But in working with Adam for the last year, I can tell you it's the real deal. And what I focused on was this correlation and the movement of growth stocks versus value stocks. And what I mean by that are growth stocks would be similar to like an Apple or an Amazon, a big tech type stock. A value stock would be those stocks that come in with very low price to ratios, especially compared to their peers, but have good, good solid fundamentals, meaning their financials are in good order. GE would be one you might want to consider. Bank of America, any type of financial institution would be, another one that might fall in that category. They don't all fall in that category, but some do. But I want to kind of see what the correlation was in terms of how they've moved, especially when you factor in things like interest rates. Now, it's to preface, the economy is not the market, so let's not be confused there. But there are some things related within the economy that can influence market moves. And I came across a lot of interesting stuff, and we'll talk more about that in our podcast on the weekend. But I want to bring in Adam and kind of get his take on this because he's got a lot of experience in terms of watching how the market moves and correlating that with outside forces and outside factors. So, Adam, I really just want to kind of let you take off here, and I want to just kind of say, talk about how growth stocks have moved compared to how value stocks have moved, factor in interest rates and anything else that might be pertinent in terms of what an investor would need to know looking forward.
Yeah, so this is a big ball of wax, and there's a lot of different variables and factors, so to speak, to kind of untangle here. So, kind of to set the stage, a big part of the commentary, which commentary isn't the only thing, but to trade off of or to make your investment decisions on, but you need to be aware of the commentary. Sometimes, if there's a difference between the commentary and the underlying fundamentals or market positioning of the market, that's where opportunity to make money exists. But there's really been this big narrative over the past several months about the reflation trade. Basically, the economy starting back up, interest rates have been rising. People have started to worry about inflation alongside that. So just to give you an idea, the interest rate on the 10-year Treasury note was around 80 basis points when Biden got elected in November of 2020, and it basically doubled. It went above 1.6 at the turn of basically in the first quarter in March or so is when it topped out. So really, as the last several months of that rising interest rate trend was kind of, I don't want to say parabolic, but it was certainly kind of going more than a linear trend higher. People started worrying about, they were looking at the NASDAQ, and the NASDAQ, which has led the S&P 500 and led the small cap Russell 2000 for most of this bull market that began in 2009. The NASDAQ basically stopped outperforming to such a degree and kind of even had some down months. So the NASDAQ 100 is a lot of growth oriented companies, a lot of technology companies. And so people started wondering, is the growth factor, are growth stocks kind of due for a bout of underperformance? Meanwhile, we saw the energy sector kind of roar higher out of the bottom. And so a lot of the energy stocks were beating technology growth stocks, and there's a lot of value stocks within the energy sector. So that kind of led a lot of people to say, well, is value coming back? Is the value premium, the value factor back in vogue now? So basically, I put together a video, an update for my 10X Profit subscribers, one of my premium services, in late March. And this was when the 10-year note was around 1.6. And I showed the relationship between interest rates and the relative performance of growth and value stocks. So the way it works is, growth stocks, first of all, when you buy a stock, you have claim as a shareholder to the future earnings, the future cash flows of that company. And growth stocks, relatively speaking, have a lot more of their earnings out into the future because they have higher growth rates. So if you look 5 or 10 years out, their earnings are going to be much larger than their earnings are today because they're growing at a faster rate. Well, the present value, the value today of those potential future cash flows, is always discounted by what's called the discount rate. And that's more or less what interest rates, the interest rates are used for that discount rate, the prevailing interest rates. So as the interest rate rises, the prevailing interest rate rises, that discount rate makes growth stocks less attractive because growth stocks have more of their earnings way out into the future. And at a higher discount rate or a higher interest rate, the present value of those future cash flows is much less. So as a rational investor, you would be less willing to pay a higher multiple, a higher price to earnings or price to book or price to sales multiple for a growth stock as interest rates are rising. Now, conversely, value stocks are companies that are undervalued and they're earning, since their growth rates aren't as large, you can really factor in the fact that most of their earnings are being made right now. And so the present value of today's earnings are, relatively speaking, higher in a rising interest rate environment. So that's really why I believe that from November of last year, even before that, but really from November through March of this year, you saw a resurgence of the value premium, the value factor, and you saw growth kind of slip. But in that video that I ran to my premium subscribers in late March, I thought that the rise in interest rates was a little bit overdone. This was when rates were about 1.6 on the 10-year note. And I said that if I was speculating, I would bet that the 10-year falls back down to 1.2% at least before it goes up to 1.8 or 2%. And that's more or less what's happened. We've seen the rollover in rates, and right now I'm seeing the rate at about 1.28. So it's fallen pretty hard over the past several weeks, even after the FOMC meeting a couple of weeks back, where they were a little bit more hawkish. But it's not just a question of value versus growth. You also have to look at the small cap effect. So the JP Morgan Guide to Markets just came out, and they showed a chart. Let me pull it here. Basically looking at past recoveries. So the recovery from the tech bubble, the recovery from the '08 Great Financial Crisis, and the rebound from the March 2020 COVID crisis. And in all three of those cases, small cap stocks outperformed large cap stocks out of the bottom. And that's exactly what we've seen this time around. So it's really kind of hard a little bit to fully disentangle the effect of the small cap effect. Small caps tend to beat large caps over the long run, but that hasn't been the case during this bull market. And versus the difference between value and growth, because just because a company is considered a growth stock doesn't necessarily mean it's a bad value. So growth isn't the same as overpriced or expensive. So those are just a couple of things you have to disentangle. I will say that year to date, the two factors that are basically earning the most premium, in first place year to date is the value factor, and in second place is the small cap factor. So really, if you not that you want to give up on growth stocks, not that you want to give up on large cap stocks, but you want to probably look at your portfolio. And if you're under allocated to small cap and value stocks, now is a good time to kind of wade back into those waters. I did give a presentation at the end of 2019, put together an all-weather portfolio of 20 positions that were meant to kind of weather any storm. And one of my recommendations was a small cap value fund, a Vanguard fund with the ticker symbol VBR. So that's something to look at as well.
And one thing I will say to kind of tie this back is if you visit Money in Markets, one thing that we talk about a lot is our green zone rating system. And this is a system that Adam has developed over the course of, he spent countless thousands of hours developing this system. And what it does is it takes all the stocks rated on the market. There's about 4,900 of them right now. And it runs them through and ranks them based on 6 different metrics. There are 3 fundamental metrics and there are 3 technical metrics. And the beauty of using this system, if you go to moneymarkets.com, it's free to use, actually. You just use there's a search bar up on the top. You can type in a ticker and it will actually pull up what its ranking is. You can actually, you're not forced into trying to choose between a value stock or a growth stock. You can actually find companies that rate well with both factors. And that's an ideal situation to be in, because, the market fluctuates. Nothing ever goes up in a straight line, and nothing ever necessarily goes down in a straight line. So you kind of want to be on good equal footing here. And so Adam, that was a great explanation. I will say that if you watch the podcast coming up on the weekend, I'll dive more into this topic. We'll talk about a lot of the same things that Adam just went over. Plus, I will give you a potential recommendation for you to look at to capitalize on an upcoming trend. So make sure you check that out. That's coming out, I believe, on Saturday. You can check it out on YouTube, or you can get it on your favorite podcast syndicator as well, Apple, Google, Spotify, so on and so forth. So so there's a lot of things out there. Of course, no one has a crystal ball. No one can accurately forecast the future. Anyone who tells you that they can is probably going to sell you snake oil as medicine as well. So just bear all that in mind. There's no absolutes. So you really just have to watch things and understand and learn from guys like Adam, for sure, who kind of point you in the right direction and let you know what these things mean when you see these things come up in the market. So Adam, thanks so much for taking the time to answer my question this week. If you do have a comment, if you have a question or anything like that, please ask it. I love to ask Adam questions. I ask him almost every day. Sometimes I think he might get a little frustrated with that because of the frequency in which I do it. But I love to do it. I think he provides great insight to a lot of different things across the market, the broader market. You can do so by emailing feedback@moneyandmarkets.com. Drop that right down there. Feedback@moneyandmarkets.com. Make sure you check out moneyandmarkets.com every day. Adam, Charles, myself, we provide, and our entire team really, we provide safe, sound, smart, simple, profitable investment information for your portfolio. You check out our videos here on YouTube. We've got a lot of them. We've got more coming up. So Adam, thanks a lot. Thanks so much for taking time out, and glad to be back, and looking forward to doing this again.
Thanks. I'll see you next week or later today, as the case may be.
Absolutely.
Take care.
Uh-huh.